Hi, I'm Elysia Stobbe, and in this video, I'm going to share with you the mortgage lingo you need to know to sound like a mortgage pro. By the way, if you like the information, all you need to do is, there's a free guide you can grab. Just click on the link below in the description, and it's yours for free. My gift to you. Hi, I'm Elysia Stobbe, your Mortgage Millions mentor, and I wrote the book on mortgages. In fact, I'm the #1 best-selling author of How to Get Approved for the Best Mortgage Without Sticking a Fork in Your Eye. So when I say that I know mortgage lingo, I wrote the book on mortgages, so I definitely know the mortgage lingo. So we're just going to start with a few simple ones today so that you don't sound like a mortgage rookie, because that's the last thing you want to do on a phone call with a client or a realtor, another strategic referral partner. You don't want to sound like you don't know what you're talking about. So the whole reason I share this with you is because I've been in your shoes. I remember when I was a rookie, when I was a loan officer, I remember sitting in a sales meeting and they were talking about seasoning requirements. And I just remember thinking, what does salt and pepper have to do with mortgages? I don't understand at all. And it's because I didn't know what I didn't know. So let's start with seasoning. So seasoning is a requirement for assets. Most assets need to be seasoned for at least 60 days, 2 bank statements, 2 months worth. And all that means is it needs to be in the client's bank account. It can't show up from you can't use mattress money for closing cost or down payment. It'll get backed out of your loan, or depending on the policies of your company, that whole loan could go kaput if you have unseasoned funds in the transaction. So really important to make sure that if you have first-time home buyers planning, that they go ahead and put that money, take it out of their mattress and underneath the mattress and put it in the bank and make sure it's there for 60 days before they go under contract. So that's what seasoning is. DTI. DTI stands for debt to income ratio. Now there's a couple different ways we talk about debt to income ratio, DTI. There is a front and a back debt to income ratio. There's also the front and the back is also called the top and the bottom debt to income ratio. So the front or top ratio for debt to income ratio is the full current mortgage payment. So that's principal, interest, taxes, and insurance. And again, it can be homeowners insurance, mortgage insurance, at least a homeowners insurance. If they're not putting down 20%, it's going to have PMI on it. And if they are putting down 20%, if it's FHA, it's still going to have mortgage insurance on it, unfortunately. Also that would include any homeowners association fees as well as condominium fees in there. So principal interest is repayment of the loan. TI is taxes and insurance. And then it's also going to include the ancillary fees. So that's the front end ratio or top ratio when we talk about debt to income. And then the bottom or back debt to income ratio is this payment that we just talked about, the front, plus all the other payments. So their minimum credit card bill that's due, their car note if they have one, all the other debts that show up on their credit report. Okay, so that's everything plus. So it's the front, the housing ratio is the front, and then the back or bottom ratio is the house plus everything else. And you're going to divide that by their gross annual income. Okay, so you're going to take the housing payment divided by the gross annual income is the front debt to income ratio, and then the housing payment plus all their minimum monthly debts that show up on credit divided by their gross annual income is the back debt to income ratio. And typically this is where people have the challenge. Sometimes they want to get approved for a little bit higher price point, but they really can't until maybe they pay off one of these. So wanted to share that with you. So that's debt to income ratio, what we call DTI. The next one we can talk about is LTV. People are like, what's an LTV? That's loan to value. So you're going to take the sales price minus any down payment, and then that's the loan to value. Okay, so let's say, because you're going to start with 100%, right? And let's just use round numbers. Let's just make it a $100,000 house, or better yet, let's make it $1 million house, because those are the loans that I like to close. So you guys dream big and focus on those if you want. But there's a whole, actually, I teach a whole class on your ideal avatar, which is a whole nother subject. But yeah, so which is great because if you focus on those high ticket, depending on where you are, that can be easy to break into, or it can be very challenging. It really depends on your skills and experience, as well as, but don't be scared off if you're a rookie at all. It also depends on your company's loan programs and how competitive they are. So, and your geography, where you're located. So anyway, okay, so let's go on the $1 million home. So loan to value, let's just say we're gonna use the $1 million price point. Again, it's 100%. So if my client puts down 20%, that's $200,000. That leaves me with an $800,000 loan. And this is my loan to value, right? So that's gonna be 800 divided by $1 million equals 80%. Again, you can also take the sales price as a percentage, subtract the percentage of down payment, 20%, and that would give you the 80%. So again, so down payment is going to be typically what they're going to bring at the time of closing. It's not necessarily a binder or earnest money deposit. Sometimes I worked with a realtor a few months ago that confused their down payment with their binder. That was a little unnerving. Just keep in mind, people are human, realtors are human, and rookies make mistakes, and I still make them. Not as often as I used to, thank goodness, but things are changing all the time in the mortgage industry. And the best we can do as experienced and as rookies is own it. So, okay, so binder, earnest money deposit. So in binder or earnest money deposit, depending on what they call it, really just changes with what part of the country you're in or your state. So that varies. Okay, so next, just real quick, we're going to talk about people will talk about loans and say Govy. So Govy is short for a government loan. Okay, so basically there are two main types of loans. There's more, obviously, right? There's a ton of loan programs. But the two main types are conventional is one and government is the other. So conventional, and most of your jumbo stems from there because there's super conforming and jumbo goes off the conventional route. But the government loans are going to be FHA, VA, and USDA. So for the most part. So when somebody says Govy, it's usually an FHA or VA loan because there are some instances when USDA can actually be underwritten as conventional depending, but that's really the exception. Anyway, so most of the time when people talk about Govy, they're talking about VA and FHA loans. So that's that information. MI, PMI, upfront funding fees, what are all those? So mortgage insurance, MI stands for mortgage insurance. If it is a conventional loan, it will have PMI, which is private mortgage insurance, which is basically there are 4 or 5 large companies in the country that insure the majority of conventional loans that have less than 20% equity, which is when mortgage insurance is required. Anytime there's less than 20% equity, mortgage insurance is required on a conventional loan. There are a few ways to skirt around that. The mortgage insurance can be built into the interest rate, which is not my favorite choice. They can buy it out up front in one lump sum, and there's usually a break-even point on when that makes sense for the borrower to consider. Or, of course, they can make the monthly payments for mortgage insurance. So that's with conventional. For mortgage insurance, for government loans, for FHA, whether you put down 5% or 50%, unfortunately, mortgage insurance is now required on all FHA loans. It's also required on USDA loans. For VA loans, they are insured by the VA, however, by VA loan guarantee. However, there is no monthly fee to the borrower for that. And for all government loans, there are upfront funding fees, and those fees vary depending on the loan type. We won't get into those, and if it's a purchase or a refinance. So lots of fun nuances to know. But if you keep your categories really split that simply, conventional and then govy, and then within those, that's the way I've kept it clear in my head for years. So hopefully that'll work for you. And then since we're talking about conventional, there's also Fannie and Freddie, which Fannie stands for Fannie Mae, Freddie stands for Freddie Mac, and that's all conventional loans are run either Fannie or Freddie. So it's their underwriting guidelines. There are a few nuances between the two, but those are the ones. So when somebody says, "Oh, I don't," they have a conventional loan or they're doing a conventional loan, and they're like, "No, I don't have I don't have a Fannie Mae loan." Well, actually, Fannie Mae, absolutely, you have a Fannie Mae loan. It says here on your credit. So, but a lot of people don't understand that. And there's always a nice way to show that you have some information without making the client sound, or you definitely don't want them to feel like they're wrong. So be careful there. And then last but not least, HUD. This is a big one. They're in charge of a big sector of what we do, right? Yes. HUD stands for Housing and Urban Development. So just one more to put in your glossary, your bag of tricks there. So I'm Elysia Stobbe, your Mortgage Millions mentor. I hope this has been very helpful for you. And you can just click on the link below, subscribe and share and like, and come back again for another one. Thanks.